Hi everyone, my name is Karina Rao and I lead ParaFi's Investor Relations team. We wanted to welcome you to today's session of our virtual Fireside Chat series. Today we'll be hosting the founder and CEO of Credix, Thomas Bohner. ParaFi is an investor in Credix and one or more of its managed funds may utilize the Credix platform. Please note that this Fireside Chat is not to promote, endorse, or recommend ParaFi's advisory services or any fund managed by ParaFi, nor is this a recommendation of any particular investment, protocol, security, or other asset. The views discussed in this chat are the views of the individuals and not of Credix or ParaFi. This Fireside Chat is being recorded. We are excited to offer these Fireside Chats and hope that our audience respects the intimacy of the event. While there is no formal duty of confidentiality, please do not repost specific quotes or views from the discussion to Twitter or other social media. As a reminder, we encourage people to submit the questions during the discussion. With that said, I will introduce our speakers for today. Ben Forman, the founder and managing partner of ParaFi, and Thomas Bohner, the founder and CEO of Credix.
Thanks, Karina. Really appreciate it. Thomas, how you doing?
All good. Thank you, Ben and the ParaFi team for having us.
Great. Yeah. So I'll keep this brief because I think there's some construction going on outside, and let you do most of the talking today. But there are a number of different areas that I think would be fascinating to talk about. Real-world assets moving on chain. Talk about permissioned versus permissionless DeFi. I want to talk about credit markets. I want to talk about the Solana ecosystem right now, but maybe the best place to start is really with the earthquake that happened at the beginning of this month in the crypto space, FTX. You know, where were you when you learned about FTX? What was your reaction at the time? Take us back to maybe that moment and how you've processed it in the aftermath.
Definitely. So it already sounds like a bunch of interesting topics to talk about, but we could definitely not talk about FTX. I remember it quite vividly. So I was actually on a call with one of our other investors in Credix, Motive Partners, which is an Apollo-backed private equity firm that is focused on financial markets technology and co-led our Series A with the ParaFi team. And the first reaction that I really had was disbelief. We had been working directly with Alameda Research as a liquidity provider for Credix. And personally, I was a user of the FTX platform. And I think for everybody, SBF, the founder and CEO of FTX, had always been seen as this prodigy of the industry. And what I really liked about them and how they came forward was they had this regulatory first and institutional approach, which is very similar to Credix, where we take like compliance and regulatory very serious. We try to work together with the regulators and we try to work together with the institutional capital. Now, of course, when everything happens and the moment of disbelief was over, we got an emergency team together within the Credix team. And we designed an emergency plan. For us, there were three most important things. I think the first part was to talk to all of our liquidity providers, talk to all our equity investors, and talk to all our technology partners, really understanding what is the effect on the day-to-day, what is the contagion effect on the potential partners, and how should we restructure and potentially refocus what we're doing at Credix. And so that was the initial reaction with us at the team.
So now that you have maybe a couple weeks of perspective, what does an event like this really mean for founders in the space that are building projects maybe completely unrelated to centralized exchanges? Does it have a direct impact? Does it have an indirect impact? How are you kind of thinking about the path forward?
Yeah, definitely. So I think it had for us with Credix, luckily enough, it had no direct impact to say so, but it had a pretty big indirect impact. Now, one of the first things that we have seen there is, of course, a liquidity crunch in the market. A lot of liquidity evaporated out of the crypto DeFi ecosystem in general, more specific in the Solana ecosystem where we're building, and we can talk more about that later on, definitely. We have seen, of course, an increase in distrust in the technology and the industry, because it's not the first time that this happened. We had the Celsius, we had the 3AC at the beginning of this year. So that is indirectly, of course, what we see, a slowdown on the growth, a slowdown on the impact that we can have, and definitely a more wait and see approach from institutional capital to come in. At the same time, I also want to immediately touch upon something positive and something that has been reinforced by this that happened, and that is there is the need for more real world use cases, specifically in financial services, bringing real world assets on chain, but do that in a more decentralized manner, leveraging the DeFi transparency. And so that's how we see a positive side out of this event.
That's probably a good segue into sharing maybe a little bit about your background. I mean, you come from traditional finance and technology. Would be helpful for everyone to understand, why you chose to build Credix in particular. You could have built anything in the blockchain space or outside, but what attracted you to this particular problem?
Yes, that's a very good point. So indeed, my background. So after I finalized my specialization in finance, I went to London, work in traditional banking, work with many of the big banks like Barclays and HSBC, and very quickly I started realizing that the main advantages, the main innovation in banking was going to happen driven by technology. And so I moved from the traditional finance side into more the technology side. And there was one particular technology that very quickly grasped my attention, and that was the blockchain technology. Very quickly, I realized it had the potential to have the same impact as the internet on the global financial services industry. And it had the potential to really rethink some of the business models as we know them today in financial services. Now, during my career before building Credix, I had been working a lot with global capital market infrastructures, think stock exchanges, large custodians, but also large investment banks, to help them and support them rethink their core financial infrastructure and put that onto blockchain technology. There are also a few points that I realized from having those conversations is that there were a lot of smart people in these banks and in these institutions, and a lot of them had like very bright and great ideas to rethink credit markets, rethink equity markets, but it was very hard for them within the certain culture mindset, within the certain centralized organization that they were working, to build something at scale efficiently and do that really by disrupting themselves. And so that's where the basic idea from Credix started to come from, to really solve from an outside platform perspective for the tokenization of credit and assets.
When you decided to start Credix, there were a number of other companies in the space that had attempted to solve a similar problem, this idea of taking an asset in traditional capital markets and kind of tokenizing it and moving that asset on chain. And many of them had failed. The real world assets were a theme that was talked about in 2017 and 2018. There was very little traction, maybe aside from stable coins, which is the one area we can point to, fiat-backed stable coins. But outside of that, there wasn't really much traction. So what emboldened you to kind of take the risk, and how is Credix approaching this problem maybe differently than some of its predecessors?
Yes, I think that's a very good point. And indeed, let's go a bit back into history. Where does this whole tokenization of assets come from? And indeed, it started with in 2016, 17, we had the ICO boom, right? So there was this idea of using fundraising and tokens on chain to bring assets on chain. But I think the biggest problem for scale was that most of it was driven by greed and quick money schemes. There was a lack of regulated players, like, for example, Circle with their USDC was not even there yet. We didn't have the stable coins yet as we know them today. And there was not really the idea of building a decentralized financial market infrastructure. The concept DeFi wasn't even there. So we saw a small and quick rise, but very quickly that went down again. I think from there on, we saw a second wave. And that second wave was enterprise blockchain. It's a bit what I was referring to before. JP Morgan, the Australian Securities Exchange, they all saw what was possible with the technology. So they tried to rebuild and rethink some of their own infrastructure on the blockchain. Also there, we didn't really see the massive traction because of the difficulty for such large incumbents to move quickly to disrupt themselves. Now, why did we think about a year ago it was a good moment to start with Credix? Is that we saw like, hey, DeFi is getting traction. We have regulated players that are building stable coins that can be used to move the value globally. And we have big financial institutions that start to realize that building private closed loop systems is not the future, but that want to be a part of a more public open finance ecosystem. And at the same time, we saw the more crypto natives also realizing, hey, if we want to grow beyond a few billions of assets, but move into trillions of dollars of assets, we need more productive, real yield on-chain generating products. And that formed for us the perfect storm to go out in the market and launch Credix.
So in very simple terms, I think it would be helpful for you to describe what is Credix, specifically why does it make sense to move debt or credit on chain and tokenize it? Like what specific efficiencies are you unlocking relative to the analog financial system? And then I would love to kind of get into all the conversations you're having with institutions and the growth of the network. But maybe just first, simply like what is Credix attempting to do?
Yes. So at the core, Credix is a global platform that provides liquidity, being it capital, against tokenized assets. This means we have built a blockchain protocol that allows for the tokenization and the securitization of assets, starting with credit. On top of that, we have built a marketplace model where we connect institutional investors with asset originators. We'll give you an example there. We might have an asset originator on the network that is specialized in student loans or car loans. They can come to the Credix platform, tokenize and securitize their portfolio, and then distribute it, syndicate it to a network of institutional investors, hedge funds, asset managers, family offices, crypto native, and more traditional finance. All of them today active on the platform. And we, with Credix, we have an emerging market focus today that we started with, and we're active and live in Latin America. So I think that is the core of the Credix platform. Now, let's indeed dive a bit deeper into why do we take this tokenization real-world asset approach? Where do we see the benefits? I think first of all, what is a real-world asset? The way that we look at it from a Credix perspective is that we bring the rights, the obligations, and the ownership structure of an asset into a digital tokenized form on a blockchain. This can then be a regulated financial instrument think about a loan or equities, but it can also be a new kind of asset, like music rights, for example, copyrights, for example, where we can start thinking about the financialization of those assets. Now, the biggest impact that we believe for assets will be the ones today that are not traded electronically yet. That is why we have chosen private credit to start with and emerging markets, because it's very paper-based and there is a lack of infrastructure. All right, so now that we understand what Credix is doing and we have the tokenization understanding, I think it's good to look a bit at like the benefits, the real and direct benefits that we see out of doing it and the feedback that we get from our stakeholders and ecosystem. I think first of all, by building a global platform and by doing tokenization, you can have a broader investor base. What do we mean with that? By the tokenization, you can also use fractionalization, and you can make it easier for people to access certain financial instruments. Here, a good example, some recent announcements, KKR doing something with Securitize, Apollo doing something with Figure. They want to broaden their investor base. They want to open it up to new kind of distribution channels through tokenization. That then also brings a broader geographical reach. I think there also we started to see the move again from private blockchains to public blockchains, because a public blockchain is global by nature. That is also why I started saying Credix is a global platform by default, enforcing very easily cross-border transactions. Thirdly, comes back to assets that today have no infrastructure. So it is really putting it on the blockchain, tokenizing it is a generic technology infrastructure update. The blockchain is resilient, no single point of failure, and we move from paper-based exchange to digital value exchange. That then can result in better settlement times, trading, finality, instant settlement without breaks, and a decreased cost for reconciliation. Everybody that has been in financial services industry, and I think on this call we have a lot of them that are very experienced in it, they know how many third parties are involved often in these transactions. I don't say that the blockchain will cut like 90% of the intermediaries necessarily, because I believe there are a lot of intermediaries that also have a role, but it can make their jobs a lot more efficient, a lot more cost efficiently. And also by doing that, we can create better automation and potentially create new business models like secondary markets and increased liquidity for illiquid assets. And then the last thing, which is probably something that we realized again with the FTX debacle is very important, is transparency. Asset liability management, collateral management. I think we have seen it in 2008, having a good understanding of what the collateral is and how it's priced. We have seen it now again, asset liabilities, how are they managed? If we can do that all on chain, that brings an immense amount of value.
Yeah, that was a great, like very thorough reasoning around all the benefits of tokenization. I remember back in my credit days when we would want to buy a private loan that had been originated by someone else and it was going to be assigned to us. It took typically like I would say 4 to 6 weeks to document that purchase, understand what accrued interest was on the loan, pay legal fees, perfect liens, review the legal docs, which will vary, deal to deal. Like different credit agreements will have different, covenants, and which are very important to understand. And so, if you listed like 6 or 7 different things that all collectively kind of form the benefit of tokenization, but each one of them almost individually is a major problem in the financial system today. I think the other string I want to kind of pull on a bit that you kind of touched on very briefly is this idea of data capture. So in traditional fixed income markets, particularly private credit, you have a number of bilateral loans, private lender lending to a private company. And all of that data around kind of repayment history and credit worthiness is not captured anywhere. It's kind of like lost. And so there's this idea around, hey, if you're able to capture that data, if the supermarket chain in Brazil can maybe say, hey, look, here's my credit history over the last 20 years, perhaps they can access lower costs of capital. Can you talk a little bit about kind of some of your efforts or like your vision as you look into the future around kind of the data capture play within fixed income markets?
Definitely, and I think the emerging market example is a very good one, because there we see today that there is a lot of appetite to invest in emerging market credits. There is a lot of like very high quality credits where there is yield arbitrage to be done, but it's really indeed like the lack of transparency on the credit history and the lack of transparency, how is the collateral structure and how can we trigger the governance on that collateral, that results in a very difficult way to access capital and a very high cost of capital for these institutions locally. So there, the view that we really have is that we start with providing and putting like the core data architecture on chain. You have the originator on chain, you have the private credit asset on chain, you have the collateral on chain, and you can start all linking that all together through business logic, often referred to as actually the smart contracts in the world of blockchain and DeFi. Now, a very simple example of what we can start doing now is that we say like, look, if indeed there is a secondary market transaction and you buy part of a bond, let's say, instead of having to do all the reconciliations with the cash flows, think about what do I really own, where is it sitting, who was the originator, what is the history of the originator, all of that can automatically be seen on chain. And by buying the token, you redirect the cash flows. Another example where we see a lot of value happening is indeed, let's say a covenant is broken, there is not enough capital to do a repayment, but there is an escrow account on chain being set up. Automatically we can trigger that escrow account. No third parties needed, no escrow manager needed, no reconciliation needed, and this can be instant. And that increased transparency, increased comfort in the processing of the credits and the collateral, then can result in higher capital velocity and efficiency, lower costs, and more volume that can be deployed in these kind of products.
Yeah, that definitely resonates. I mean, I remember just the amount of brain power in operations departments that went into calculating excess cash flow sweeps and amortization payments and accrued interest was across multiple firms. The buyer and seller of a particular credit instrument both had to independently reconcile those numbers and make sure that, and agree with one another. And so I think we can agree, like if we were rebuilding credit markets from scratch today, we wouldn't necessarily use the same approach that we've taken. We've kind of evolved to this point over the last 40 years since high yield markets really got their legs and private credit markets have emerged. But just from first principles, there are quite a few inefficiencies in debt. Debt we've built up, technical debt we built up over time. So I think maybe just to kind of get back to like the nitty gritty practical of Credix, can you walk through just a very simple example of a loan on the Credix's platform? There's an asset originator you pointed out that's putting up first loss capital, is directly facing a borrower today in an emerging market, and then you have senior capital that's coming in primarily from BDCs, private credit firms in developed markets. Can you kind of talk through how the unit economics of that supply chain kind of work, how money flows through the system, just with kind of a simple example?
Yes, exactly. So let's take our example of car loans. So we have an asset originator that has a portfolio of car loans, and they want to securitize that to get access to capital and to liquidity. This provider will come to the Credix platform and will first have to pass the Credix underwriting vetting process, making sure we have the highest quality of standards of assets and originators on our platform. We have automated this a lot. This is a lot data driven. And once they pass that, now the deal can be created on the Credix marketplace. What does this mean? We have a data room with all the data, and we have a bunch of emerging market focused, high yield focused funds who can subscribe to the mezzanine tranche. So they can take a higher yield piece, they can take a little bit more risk, and they can see all the detailed data of the originator. By investing in this, they will invest their US dollars, their stable coins in the mezzanine smart contract. So now we have the junior filled by the asset originator, the mezzanine by specialized credit funds, and then we need a senior piece of the capital. For the senior piece of the capital, we provide a more flexible capital structure, which we refer to as the liquidity pool. The liquidity pool is where asset managers, high net worth individuals, everything accredited investors can deposit their capital in a more passive investment instrument, diversified across different asset classes, diversified across different geographies, and only senior exposure. So now we will fill the deal with the senior capital. Now the deal goes live, the borrower receives the funds, and now the first magic happens with the repayment. Instead of having to do multiple repayments and reconciling the repayment structure and the collateral structure, we automatically receive a payment from the asset originator to its deal smart contract, and we will automatically calculate the waterfall. What are the fees that need to be charged? What are the interest and the principal to the different tranches that we need to pay? Do we need to put money in an escrow account? We can check, are all the on-chain covenants met? And this is like literally a process that happens in a matter of seconds. And the capital is distributed to all our investors, and they can then choose to reinvest that or get some liquidity on their capital.
And to be clear, this is all happening through smart contracts on the Solana blockchain and all using USDC as a stablecoin?
Exactly. No manual intervention, everything happens directly on the blockchain.
Great. And one other point that maybe not everyone on the call is familiar with is you've built this platform in such a way that it's very different from other DeFi platforms. With other DeFi platforms, anyone can connect their non-custodial wallet, start lending, start borrowing. Credix is different. It's permissioned, it's KYC AML'd on both sides. So in order to provide capital, you have to go through a KYC AML process and and basically get whitelisted. Can you talk about why you took that approach as opposed to the approach other DeFi protocols have taken?
Yes, exactly. So this has mainly driven this decision by the stakeholders that we work with. We work with US-based large asset managers. The asset originators that we work with are often licensed firms to originate lending in these markets like Brazil, Mexico, and Colombia. And so they need to adhere to the highest standards of KYC and of AML. And we have directly incorporated this into the platform. And this really came from the thought that we say like, hey, if an institution invests through Credix, we want them to have the same confidence around KYC AML than they would use a traditional product. We want them to invest in the same quality of credit assets as they would do today on bilateral relationships, but we want to make it more efficient, more transparent, cheaper, and be able to do it at a better scale. But there is all the good things of the traditional markets of having controls understanding your counterparties, and having deep credit and underwriting happening on the assets is what was good, and we kept that into the platform.
And what you've been chatting with some of the biggest asset management firms in the world, some of the biggest lending, some of the biggest private lenders. What feedback are they giving you on Credix? What type of traction have you gotten to date? And as you look into the next like 6, 12, 18 months, what do you kind of expect to see in terms of growth?
Yes, exactly. So I think we have seen three main challenges that are being brought up and that we're actively working on solving. First is really more getting comfortable from a technical operational perspective with the tooling and the technology. How do we do custody of the assets? How do we access and use stable coins like USDC? And also often something that we just see is that they don't necessarily have the people with the right operational skill set or training to use these new kind of technologies. Now, all of them, and I'm speaking the Apollos, the KKRs, the Blackstones, all of them are hiring them and building the teams, and we work very closely together with them, but it is still a gap that we need to fill. Secondly, is that indeed, they often, when they hear about DeFi, they think moving away from regulatory rulings and compliance. So there is education to be done. Like, okay, hey, we still use KYC and AML. We use the DeFi transparency, but we built an open finance platform, but with controls into it. And then it's also not always easy for them to navigate, okay, we are now buying this credit asset and it's represented as a digital asset. What is different for us on the recourse of the asset, on the recourse of the credit? So there also we're doing a lot of heavy lifting within Credix to make sure they get as comfortable as they would be buying this as a traditional asset. And then lastly, something that we also see is that by bringing in people with traditional finance expertise into the DeFi ecosystem, we can build trust with them. We can give them the same experience. We can talk the same language. And so that is also why Credix has this healthy mix of technologists, research, PhDs who have been in the crypto smart contract space for a very long time. But we also have people from Deutsche Bank and credit funds that have been doing credit for like 20, 30 years that bring their expertise and that can talk to these institutional finance players.
And given you're building a marketplace, you have lenders and borrowers, like what side of that marketplace are you finding to be more challenging to build critical mass in?
Yeah, so I think today it's more the capital supply side. So we have focused, so Credix has now been around for 12 months. We have built a vast and very high quality ecosystem of asset originators that have been underwritten, approved. We have done the first $30 million in financing. We just signed a $150 million LOI with one of the largest US-based asset managers and a fintech company in Colombia to do the largest on-chain tokenization deal ever. Now it is really, how do we get more participants on the capital supply side comfortable with this? How do we start onboarding the family offices, et cetera, as first movers in this ecosystem?
And if I'm a family office and I'm investing in, private credit, in, traditional markets with normal credit agreements, and let's say I'm earning 10%, what's the pitch for why I put my capital onto Credix and buy the same, finance the same borrower and earn 10%? Do I really see the benefit of those cost savings? Is there a bit of an innovator's dilemma? Would be curious to kind of what when you're being told no, what is typically the reason why?
Yeah, That's a good point. So what we continuously try to do is when we have cost savings, to channel them to both sides of the marketplace. So we channel something back to our asset originators, and we channel some yields to our investors. There, for example, we can see already that we have done some deals with asset originators that in traditional markets, as an example, would yield 13%, and we channel them back as like 100 to 150 basis points higher yielding to our investors. Of course, what do we always see? There is kind of an educational process, an onboarding process to go through, setting up the tooling and the infrastructure, understanding the recourse and the kind of assets on the Credix platform, and getting started. Now, here as well, what we have done is we have made this onboarding process as seamless as possible. So really from our experience, we're able to get family offices and investors comfortable and onboard them in 3 to 6 weeks time on the Credix platform. We support them in setting up the tooling. We work with like high quality law firms and partners. We have the legal opinions to get them on board pretty quickly and build that trust with them.
Got it. And why did you choose to build this on Solana? And given everything that's happened with FTX, is that how are you kind of assessing that decision?
Yes. So we originally chose Solana from a very technical driven decision-making process. So whilst at the time that we started, Ethereum was the best, not the best, but the largest DeFi ecosystem, we saw that there was a big issue with using Solidity for creating like a more high scalable, performant, low cost kind of infrastructure with more secure programming. Solana, who came up with a new, very ambitious architecture and using Rust as a programming language, offered a solution for that. And at the same time, they had kind of an institutional approach with the backers that they had. We have been building now for a year on Solana, and whilst it had its moments technically and some of the challenges, we have been very happy and excited about the progress. And so we definitely remain committed to the Solana ecosystem. We believe to have it as an asset execution engine where we can process data at a very high speed, where we can build very flexible modules for asset creation. It is the best chain out there at the moment. Does that mean we are married to the chain and we're not looking for cross-chain integrations and getting liquidity from other chains? Definitely not. We're very close to a lot of the other L1 teams. We're very close to the Wormhole team, thinking about cross-chain and bridging strategies. But we believe that the Solana ecosystem and foundation is strong enough by itself to survive this FTX situation. And of course, that is also backed by a lot of the conversations and risk management we have done with them.
And as you think about Credix, Credix today does not have a token; it's a company, and it could, I guess, monetize as a SaaS company in a traditional Web 2 format, but using blockchain rails as kind of its core product, or it could become a network. If I'm an institution today providing capital, senior capital to Credix, or an asset originator or a borrower, am I taking counterparty risk to Credix, the company? In other words, would it be beneficial to decentralize and have a more credibly neutral network that's processing these loans, or is that not the right way to think about it?
No, I think that's a very fair point, and I definitely think if we think about the future of credit and financial markets, we believe that it will be more decentralized. Now, there is a big but here as well, and I think it is at first we need to see more scale. We need to go to the first phase of institutional adoption and get them comfortable by using digital assets, real world assets on chain and investing in them. And only once we have done that, we can get them more comfortable with decentralizing the network, and Credix can become a more decentralized platform with more decentralized governance and decision making on, for example, the credit underwriting and the accessibility and the structure of the platform. But I think realistically, we're speaking 2-3 years from now that we will start seeing that evolution come.
As you look into the future, maybe just look into a crystal ball for a second and think about the world in like 5 to 10 years. What could a platform like Credix ultimately be at that point in time, if it fulfills its kind of your vision long term?
Yeah. So we believe that we will be a global platform where debt and credit will be processed at a highly efficient way, at a very low cost, and where retail investors can access the kind of credit in a very fractionalized, open and transparent way, where institutions can come in and use it truly as their core infrastructure for the primary issuance and secondary trading of credit and price discovery, and where asset originators, SMEs, and corporates can directly come to the infrastructure to get access to capital in the most efficient way, depending on their capital needs. Now, what we also believe is that we will not be having this discussion anymore if it's DeFi or blockchain or crypto, but that it's really going to be an infrastructure technology layer integrated in your neobanking application where you buy the credits, integrated in the core banking systems of the Goldman Sachs and the JP Morgans of the world, and being new kind of interfaces into marketplaces and distribution channels. And I think the example that I always like to take there is, I hope somebody in Europe can open its phone, see that there is an interesting investment opportunity in Latin America, in 2 clicks can invest in that. In the back end, it might be warehoused by a large asset manager in the US. They can immediately sell it off. The capital is changed, the cash flows are changed, there is no reconciliation of the data necessary, but everything happens in an automated and transparent way underneath on the infrastructure.
Yeah, that's definitely a powerful vision. And I'm curious, like, how correlated is that that bull case or that vision with the price of Bitcoin or the price of Ethereum, or how reliant is it on blockchain scaling? Or is this something kind of completely independent and orthogonal to kind of the way people think about crypto day to day?
Yeah, so we believe it's totally independent. We believe that there is a global need for a more digital and a better capital markets infrastructure. And we believe there is an ask from retail capital, an ask from institutional capital to build that. We believe that blockchain is that infrastructure. And so as blockchain scales and as the Bitcoin and Ethereum price go up, that will make our path to success quicker and maybe more aggressive, but we're definitely not dependent on that.
Understood. Okay, I think we're at the 45-minute mark, so let's open it up for questions from those on the line. There should be a way to input those questions. And while we're waiting for them, I'll ask another one. So as you think about, you're building a global credit marketplace, and so you have lenders and borrowers across different parts of the world. Each part of the world has different bankruptcy codes. Each part of the world has different UCC equivalents, like we have in the US with the Uniform Commercial Code. There are different ways to perfect liens. There are different ways to enforce rights and remedies. How do you take that fragmented legal jurisdictional environment and standardize it across the Credix platform?
Yeah, definitely. So what we see there indeed is that there are definitely some differences, but there are also a lot of things that are in common. And so we definitely start from what is that common layer that we create? And it starts from, okay, what does the architecture of an asset look like? What does the architecture of a payment flow look like? And we build the platform and the technology as open and as flexible as possible to have that core set off the shelf, and then people can build on top of that, and people can implement their own rule-based systems. And that is not a problem, because let's say we now have like 2 new markets coming on chain, and they have a different way of understanding indeed one of these processing rules. They can just like have the input differently or have a different smart contract for that. But again, it will be transparent and bilateral by the 2 of them, based on the same core architecture of how to think about an asset, how it moves, and how it settles. We do believe that the compliance rails provide a competitive advantage. And so that is also why we are working in the bigger parts. Like, for example, today we're very active in Brazil, in the US. We have a lot of investors from Europe to already make them comfortable and provide them the compliance rails that we would need to get these investments going.
That's great. Looks like we've had a few questions come in. One of them is, it seems like MakerDAO lately is diversifying exposure from crypto towards real world assets. Could the senior tranches in Credix be sourced from DeFi protocols like MakerDAO in DAI?
That's a very good point. And that's indeed another big advantage of tokenization and putting things on the blockchain. It is using all the different kind of Lego bricks, the modularity of the on-chain infrastructure. And so indeed, we with Credix, we're actively in conversation with other DeFi protocols to plug them in and to use real world assets as collateral and to use their capital as senior provisioning, which is also a way for us to open it up to more retail kind of capital and give them access to this credit clause. So definitely, and we're actively working on it as well.
And there's another question here related to kind of what Chapter 2 is. After you tokenize assets, tokenize debt, what are the other ways that, what are the other features of RWAs besides kind of instant settlement or liquidity or programmability? Do you see them being used as collateral for lending, or kind of similar to how tokens today are used as an LP set on platforms like Uniswap? What's kind of your vision for that next phase of growth in RWAs?
Yes, exactly. So I think the first way is to solve for the primary issuance and the primary liquidity. And then the second wave is going to be the secondary markets and the secondary liquidity. How do we create better price discovery? How do we integrate indeed with the Uniswaps and the Aves of the world, where you can use your LP token that represents a real world asset as collateral to lend against, so you can keep the asset, the yield generation, but get some liquidity against that? And how do we create more efficient secondary markets that attract more liquidity? And then on the backbone of that, I think there is a lot of interesting things to be done with integrating into more structured kind of products on chain, in integrating with on-chain pension funds, on-chain insurance funds, getting the assets in self-insured. So again, bringing all the on-chain Lego bricks together to create a more global financial ecosystem, not only focusing on the credit debt piece of it.
The next question is, can you give some examples of how you would like regulators to treat the blockchain space? And are there any jurisdictions that you think are ahead of the curve or behind the curve?
Yeah. So I think it's important that we look at the real world asset space as like, look, this is similar as a credit or a loan that you would have in the traditional markets, but the regulators should be supportive in thinking about new ways of doing custody, new ways of doing recourse, new ways of financing those, for example, through stable coins, and provide clear guidelines that the institutions can trust. They're one of the countries that we see taking a massive leap forward, and also one of the reasons why we've chosen to start here is Brazil. Brazil has a central bank governor that is very vocal about blockchain, about central bank digital currency, about the use of crypto assets, and recently has decided to set up a working group for tokenized debt that we will be co-chairing with the Credix team, very forward looking and very much driven also by the DeFi and public blockchain movement.
Do you think in general that emerging markets are ahead of the curve relative to developed markets?
I definitely think so. And the reason why is because first, we often see that they can make a leap. So they don't have current infrastructure, they don't have the replacement costs, they don't have the very robust and complex infrastructure and legal regulatory framework that most of the more developed markets have. And also, I think they can see the need and for these kind of solutions better, like getting dollars and outside capital into the country, providing more access to financial services for the individuals. The whole financial inclusion unbanked story is something that is real and that can be definitely solved partially with blockchain technologies and solutions like Credix.
Thomas, this has been incredibly interesting, and really want to thank you just for the time. I guess the last question is, if people want to get in touch with you, what's the best way to contact you?
Yeah, so you can contact me directly over email. That is thomas@credix.finance. Feel free to connect with me on LinkedIn or on Twitter. Twitter is T_Bohner. And then more than happy to talk, answer more questions, and definitely go to the Credix platform, credix.finance, and have a look at it and at our documentation. And then Ben and the whole ParaFi team, as always, thank you very much for hosting us. It was a really interesting conversation.
Great, thanks again, Thomas. All right, thanks everyone.
Thank you.